All right, so in this video, we want to think about the other side of fiscal policy being taxation. And so we want to think about what role taxation plays in the economy, as well as thinking more about all different levels of taxation from state and local to federal, and thinking about different types of taxes from income taxes to consumption taxes. When we add those all together and we think of the sum of our national taxation system, we want to ask in this video, is that system going to be progressive? And when we say progressive, we're not talking about the progressive wing of a particular party. We're talking about the system of classifying taxes as either proportional, regressive, or progressive. And so we're going to look at what's different between a marginal tax and an effective tax or an average tax, as well as to learn how to be able to classify different taxation schemes as progressive or regressive. So this is going to cover taxation in pretty wide in scope in this video. So I think that this video is going to be helpful in a variety of ways. So first of all, it should allow you to gain a more comprehensive understanding of taxation and to be able to better interpret information as it relates to individual income taxation, and to help you make more efficient decisions when it comes to your own behavior, which could impact the taxes which you pay. I think it's also important for you to understand what kind of system we have in place as it relates to taxes and benefits, and the kind of incentives that it creates for those who earn less than $20,000 per year. Also, once again, one of the end goals of this class is for you to be aware of how government spending and taxation impact the economy, and this is kind of a continuation along that theme. Okay, so the first clarification that I want to make, the first definition kind of that I want to provide, is on marginal tax rates. So by now in this class, we should all know what the word marginal means. Marginal does not mean average. Marginal means additional, incremental. And I think that there is a just pervasive misunderstanding or rush to judgment about marginal tax rates. And I want you to interpret marginal tax rates as referring to the tax rate which is applied to each additional dollar earned in a tax bracket, not to the total income. So when we look at the types of statements made by, tax policy geniuses such as 50 Cent, we can see that he's essentially treating this 62% as a average tax rate or an effective tax rate. Really, that 62% is only going to apply to the very last dollars that he earns, the dollars which are above the highest income threshold. So for an organization such as the Tax Foundation, which we're going to rely on their statistics a lot throughout this video, to come out and say that according to Biden's tax plan, the top marginal rates in 3 states would exceed 60% is technically accurate. However, it's also, we need to clarify that that's not the average tax rate. That's not the tax rate which we're entering into the Keynesian cross model. Only the income in the top tax bracket, each additional dollar earned in the top tax brackets are going to be taxed at those rates in those states. And we'll get a better feel for that once we look at a historical example of a tax bracket. But right now, just keep in mind, marginal means the rate on one additional dollar in whatever tax bracket you find your last dollar that you earned. On the other hand, effective tax rates are going to be the average tax rates for an individual's income after it has passed through all tax brackets and the deductions and exemptions have been considered. So to calculate the effective tax rate, we're going to look at the taxes that an individual paid in the lowest tax bracket, the taxes that they paid in a higher tax bracket, all the way up to every single bracket in which they paid taxes, add them together, divide it by their income. That'll be the effective tax rate, which is clearly different than the marginal tax rate. Each individual will only have one effective tax rate, but they're going to face most likely several marginal tax rates depending on how much income they earn. And to make this even more confusing, we also have effective marginal tax rates, which are going to represent the percentage of each additional dollar of earnings that is unavailable because it is paid in taxes or offset by reduced benefits from government programs. And so here we're not thinking necessarily of the effective tax rate as representing all taxes which you pay as a percent of your income. We're thinking about the marginal rate. So how much income are you losing by earning one additional dollar? And so you could be losing that income through taxation, or you could be losing that income by losing eligibility for particular benefits, which may phase out when you earn more money. So despite what 50 Cent thinks about the combined state, local, and federal marginal tax rates and the highest income earners in New York City, we've actually seen rates of top marginal rates of taxation, which are higher for the federal government alone than they were for those three different levels of government. So since 1990 or thereabouts, we've had relatively low top marginal rates on taxation, actually since the mid 80s being below 40%. We haven't gone above that in the past almost 40 years. However, through the period of the highest rates of economic growth in our country's modern history, we actually had top marginal income tax rates, which were around 90%. So each additional dollar in the highest tax bracket earned was taxed at 90%. You can keep 10%. However, do we think that those people actually pay 90% of their income? No. That is a top marginal rate, not an effective rate. And I just have effective tax rate data from 1980, but as we can see, the effective tax rate is going to be consistently less than the marginal tax rate. Okay, so this chart has data from 1986 through 2016, and it looks at comparing the top marginal federal tax rate to the effective tax rate for the top 1%. And as we can see throughout this time frame, the effective tax rate on the top 1% for federal taxation is about 10% less. Actually, I guess at the bookend here, it's about 13% less than what the top marginal rate would be. Now, part of that is because of exemptions and deductions in the tax code, that you don't have to pay taxes on income that you donate to charity, for example. And part of it is going to be due to not all of the income of the top 1% is passing through the top marginal rate. Much of that income may be passing through lower tax brackets, which are going to average out to create a lower effective tax rate than the top marginal tax rate. Now, obviously, somebody who's earning, let's say, $1 billion in income per year is going to have an effective tax rate which is very similar to a top marginal tax rate. But I would have a feeling that probably most people in this class, and it's okay, I guess, if you don't disagree with that. That is your normative opinion, and I'm not here to evaluate that. But most people would probably be okay if somebody earns $1 billion a year if their effective tax rate is pretty similar to their marginal tax rate. So as we can see in this image, which is using data from the Bureau of Labor Statistics, we can track three different measures here, being the average hours worked per week, the top marginal tax rate on labor income, and the effective tax rate on labor income. So we can see that the top marginal rate over the past 50 years has decreased significantly, but that the effective tax rate is basically the same now as it was 60 years ago, around 20%. That it may have climbed up to 30% at one point, but in general, that effective tax rate has largely remained the same. And we haven't seen much of an impact on the average hours worked per week. I guess we can notice it decline a little bit as the effective tax rate increased, but really we're staying pretty close here to that 35-hour average per week for labor. All right, so the last relationship that I want to look at here as it relates to the top marginal tax rate is between the top marginal tax rate and total tax revenue collected as a percent of GDP. So we can see that over the past 60 years, the top marginal tax rate has declined pretty significantly, but the tax revenue as a percent of GDP has been pretty stable between 15 and 20%. So once again, changes to the top marginal rate aren't as reflective of the tax burden as we may otherwise think. That sure, we can collect more tax revenue, but unless it's going to be involve a more systematic overhaul of the federal tax system, it may not actually increase tax revenue all that much. It may not increase the effective tax rate all that much either. So to illustrate the difference between marginal tax rates and effective tax rates, let's think of an example. And let's think about an individual who in the year 2014 earned $373,000. If I were to ask you how much taxes would they have paid if the top marginal tax rate on income was 35%, you would have no way of answering this question without more information. And so to answer this question, to ask how much in taxes this individual would have paid, we're going to need a whole table, a schedule of tax rates and tax brackets, and then we're going to apply just some simple multiplication and addition. So in 2014, for example, we had 6 different tax brackets. Whether your income fell between $0 and $8,350, between $8,350 and $33,950 as well for all of these. And then the last tax bracket was for income between $372,950 and infinity. If you earned $2 billion in income that year, the marginal tax rate paid on your $2 billionth dollar would be the same as the marginal tax rate that somebody earning $400,000 a year would have paid. So clearly, somebody earning $373,000 a year is in a very different financial situation than somebody earning $33,000 a year. But it's also pretty likely that somebody earning $2 billion a year is very different than somebody earning $300,000 a year. And for that matter, somebody earning $1.5 million a year is in a very different situation than somebody earning $400,000 a year. So to calculate the total tax burden, the total tax revenue which an individual earning $373,000 would have had to have paid, we apply the marginal tax rate to the income in each tax bracket. And so we apply 10% to all income between $0 and $8,350. We apply 15% to all income between $8,350 to $33,950. And we keep doing that for all these different tax brackets. And so as we can see here, if you were to have earned, this column represents the taxes that you have paid if you earned exactly the top of the tax bracket. And so if you earned $8,350, then you paid $835 in taxes. This is not including any exemptions or deductions. If you earned $33,950, then you would have paid $4,675, which represents both the tax which you've already paid, as well as the tax rate 15% multiplied by the difference between these two values. And we could keep going with that, that calculation until we find that somebody earning exactly $372,950 in 2014 would have paid $108,216, but then they also have to pay 35% of all income between $372,950 and their income, which in this case is $373,000. So we would then subtract 373,000, subtract from that 372,950. And here we can see that this is just going to be $50. And so we then multiply $50 by 0.35, and we get that that is equal to $17.50, which we would then add to our total tax bill, $17.50, and that's going to give us total tax bill of $108,000,233.5. So if we were to calculate the effective tax rate for somebody who earned $373,000 in 2014, we would divide their total tax bill by their total income. So let's take a look at what that would be. So the effective tax rate would be equal to the tax bill. Oops. So be equal to the tax bill over the income, which would be equal to $108,233.5 over $373,000, which would give us a total effective tax rate of 0.29, so 29%. And once again, this is before any exemptions or deductions, but importantly, this looks a lot more like their tax rate, the marginal tax rate for somebody earning between $80,000 and $170,000 than it does for somebody who is earning in the top marginal rate, right? So looking at the marginal rate isn't exactly that informative for what your total tax bill will be. And once again, this isn't including exemptions or deductions, so it's possible that it could be even less. But that is how you would go about calculating your effective tax rate, which is different than your marginal tax rate. So when we think about comparing effective tax rates for different levels of income throughout the economy, we can come up with a way of classifying the tax code or different types of taxes as either being progressive, regressive, or proportional. So for a proportional tax, your effective tax rate, your tax burden as a percent of your income would stay the same regardless of how much income you earn. If you earn $20,000 and there's a proportional tax of 10%, then your tax burden would be $2,000. And if you increase your income to $200,000, then your tax bill would be $20,000. So the percent of your income that you pay in taxes stays the same regardless of how much income that you earn. For a progressive tax, then as your income increases, your effective tax rate will increase as well. And so we think that this is largely consistent with a diminishing or a decreasing marginal utility of income, that your $100th million that you earn brings you, that marginal dollar that you earn brings you less happiness than maybe your 100th dollar that you earn. That if you are earning relatively little, then that income is really important because you need it to pay for food, you need it to pay for necessities. And that even as we become middle class, we're using that to pay for college education or pay to live in a better neighborhood. Whereas your $100th million doesn't really provide you anything that your 99th million dollar would. In a regressive tax code, it's actually going to be the opposite. The tax burden as a percent of your income would decrease the more income that you earn. So when we think about whether the tax code in the US is going to be proportional, progressive, or regressive, it's not quite as clear cut as you would think based on the tax bracket and the income tax that we've already seen. That when we're only looking at the federal individual income tax, then yeah, our tax code would be progressive. But that's not the only tax that there is in the US. And to get a better idea of how we could classify our total system of taxes and benefits, we can actually turn to some publicly available data. So I got a little bit ahead of myself there, but as we can see here, this would be an example of a progressive tax where as your income bracket increases, the tax rate is going to increase as well. So as you get richer, you're paying a higher marginal tax rate on each additional dollar of income. However, when we think about whether our whole system is going to be progressive, regressive, or proportional, it depends on what we're going to consider being a tax. Is it specifically the government collecting revenue from you in a direct tax, or is it also losing out on benefits by earning more income and having your disposable income increase, or your disposable income decrease? I apologize. So here we have data from the Heritage Foundation, which is actually a conservative think tank, which looks at the effective marginal tax rate for an individual. In this case, it would be a single parent, so just one taxpayer, one person with one child, earning anywhere from $0 to $50,000. And we can see when we think about their effective marginal rate is including not only the taxes which they pay, but the benefits which they lose by earning one additional dollar. We can see that the effective marginal tax rate which they pay when they earn, let's say, their $5,000th dollar is actually 50%. That of an additional dollar that they would earn, they would only get to keep 50% of that. And that actually this decreases for a little while, but then it increases pretty steeply after earning $10,000, and even more as you get closer to $20,000. That for a single parent earning between $10,000 and I'm not sure exactly what this value is, but let's call it $15,000. For each additional dollar that they earn, on average, they're only keeping 34 cents of that dollar. They're either paying the rest of it in taxes or in the loss of benefits. And there's a what the Heritage Foundation calls a no reward zone, where if you earn an additional dollar, when you think about the benefits that you're losing by earning that dollar, you're essentially paying a 95% tax rate. So when we think about whether the tax code, the tax and benefit system in the US as a whole is going to be progressive, regressive, or proportional, it's clearly going to be progressive in the middle income range. So from $50,000 on up to, let's say, $400,000. The more income that you earn, the higher marginal tax rate you're going to pay. When we look at the lower end here, it's actually going to be regressive, where if we're comparing, let's say, under $20,000 to over $20,000, then you're paying a higher marginal rate if you earn less money, which just seems backwards. But when we think about the income range between, let's say, $400,000 and $1 million, then it's proportional. Then you're paying the same marginal rate on each additional dollar that you earn. So we have this odd Frankenstein's monster, to be a little horror nerd there, but of just this amalgamation of tax policies, which creates a combination of a regressive, progressive, and proportional tax system. So just thought this is something that you should be aware of as being an educated citizen of the country and being aware of what the tax policy looks like. And in the next video, I want to discuss the difference between fiscal policy and general taxation and spending, and why not all spending and taxation is considered fiscal policy.